As interest rates are expected to drop soon, a window of financial opportunity is opening for those ready to take advantage. Whether you're looking to save money on debt, invest smarter, or make strategic moves with your savings, understanding how to respond to this shift is crucial. Lower interest rates can mean big changes for your financial future, and knowing how to act now could set you up for long-term success. Let's dive into the money moves you can make today to benefit from this change. Interest rates have been a hot topic in financial circles recently. After a series of interest rate hikes over the past few years, aimed at taming inflation, the Federal Reserve is now rumored to be shifting gears. Inflation, although still high, appears to be cooling off slightly. This has led to speculations that the Fed may soon start lowering rates to help spur economic growth. In addition, the job market has shown signs of resilience, even with the higher interest rates, leading some economists to believe that a rate cut is on the way to prevent a potential economic downturn. This shift is significant because interest rates influence a wide range of financial activities, from borrowing money for a mortgage to the returns on your savings accounts. Lower interest rates generally mean it's cheaper to borrow money, but less profitable to save. Understanding these dynamics is crucial to navigating the current economic environment. So, how can you take advantage of these changes and protect your financial well-being? Here are some strategic money moves to consider. Number 1, lock in lower rates on loans. One of the first things to consider when interest rates drop is refinancing any high-interest loans. Whether it's a mortgage, car loan, or student loan, refinancing at a lower rate can save you thousands of dollars over time. By locking in a lower rate, you can reduce your monthly payments and pay less in interest. If you're thinking about making a big purchase like a home or car, waiting for rates to drop could allow you to get a better deal on financing. Even a small reduction in the interest rate can make a significant difference in the total amount you pay over the life of the loan. For example, a 1% drop in mortgage rates on a $300,000 loan could save you thousands of dollars. Number 2, pay off high-interest debt. If you're carrying high-interest credit card debt, now is the time to focus on paying it down. Credit card interest rates tend to remain high, even when other rates drop. By paying off your credit cards and other high-interest debts before rates decrease further, you can free up cash flow and improve your financial stability. Additionally, reducing your debt load makes it easier to take advantage of other financial opportunities, such as investing or saving more for the future. With less money going towards interest payments, you can redirect those funds into other areas of your financial life. Number 3, invest in the stock market. Lower interest rates often lead to a boost in the stock market. When borrowing becomes cheaper, businesses can expand more easily, and consumers have more money to spend. This increased economic activity often results in rising stock prices. If you're not already invested in the stock market, now could be a great time to start. Diversifying your portfolio with stocks, bonds, and other assets can help you grow your wealth over time. However, it's essential to keep a long-term perspective. While the market may perform well during periods of low interest rates, there will always be fluctuations, so patience and discipline are key. Number 4, reevaluate your savings strategy. Lower interest rates mean lower returns on savings accounts and other fixed income investments. If you've been relying on traditional savings accounts to grow your money, it may be time to reconsider your strategy. While it's always important to have an emergency fund in a liquid account, you may want to explore higher yield alternatives for your long-term savings. Consider options like high-yield savings accounts, certificates of deposit, CDs, or even bonds that offer better returns. While these may not offer the same liquidity as a traditional savings account, they can help you earn more on your money in a low interest rate environment. Number 5, consider real estate investments. When interest rates drop, borrowing to invest in real estate becomes more affordable. If you've been thinking about purchasing property, either as a primary residence or an investment, falling rates could make it a more attractive option. Lower mortgage rates mean lower monthly payments, which can increase the affordability of homes. Real estate can also be a strong long-term investment. Whether you're looking to buy a rental property, flip houses, or simply purchase a home, now could be the time to take advantage of lower borrowing costs. Number 6, reevaluate your bond portfolio. While falling interest rates often mean rising stock prices, they can also impact bond investments. When interest rates decrease, the price of existing bonds typically increases. Because newer bonds issued at lower rates are less attractive to investors. If you hold bonds, you may see an increase in their value as rates fall. However, if you're considering purchasing new bonds, keep in mind that future bonds will offer lower yields. You may want to look for other investment opportunities that offer higher returns or consider diversifying your bond holdings to include bonds with different maturities and risk profiles. Number 7, take advantage of inflation-protected investments. With the possibility of rate cuts, inflation may still be a concern. While the Fed aims to balance economic growth with stable inflation, it's essential to protect your savings from the potential erosion of purchasing power. One way to do this is by investing in inflation-protected securities, such as Treasury inflation-protected securities. TIPS are designed to help safeguard your wealth from rising prices by adjusting the principal value of your investment based on inflation. This can be a useful tool to maintain the purchasing power of your money while benefiting from falling interest rates. Number 8, monitor the impact on the labor market. While lower interest rates can boost the stock market and make borrowing more affordable, they can also impact the labor market. A strong job market is essential for economic growth, and the Federal Reserve will closely monitor employment levels as it considers rate cuts. If you're concerned about job security, now is a good time to evaluate your financial situation. Building an emergency fund, reducing debt, and diversifying your income streams can help you weather any potential downturns in the labor market. Keeping your skills sharp and exploring additional career opportunities can also provide added security during uncertain economic times. Number 9, stay informed and adapt as needed. Economic conditions are constantly evolving, and staying informed is crucial to making smart financial decisions. Keep an eye on Federal Reserve announcements, market trends, and economic indicators to understand how the economy is shifting and how it might impact your financial plans. Being flexible and willing to adjust your strategy as needed is key to thriving in a changing economic environment. Whether you're considering investing in stocks, real estate, or bonds, or simply looking to save more, staying informed will help you make the best decisions for your financial future. Number 10, plan for future rate increases. While interest rates are expected to drop soon, it's important to remember that economic cycles are constantly shifting. What goes down can eventually go back up. With this in mind, it's wise to plan for potential future rate hikes. Consider how any new loans or investments you make now will be impacted if interest rates rise again in the future. For example, if you're locking in a low-rate mortgage, ensure that you have a plan in place for maintaining payments even if the economy tightens again. Similarly, if you're investing, consider diversifying into assets that perform well in both low and high interest rate environments. Staying adaptable will ensure you're prepared for whatever comes next. This long-term perspective can help you make decisions now that will continue to benefit you in the future, no matter how the economic landscape evolves. Understanding the economic context and being prepared for changes in interest rates can make a significant difference in your financial well-being. As interest rates drop, opportunities arise for paying off debt, investing in the stock market, and adjusting your saving strategy. By staying informed and making smart financial moves, you can position yourself for long-term success. Whether you're looking to take advantage of lower borrowing costs or reevaluate your investment strategy, the time to act is now. Make the most of these changes and ensure that your financial future is secure.